where we break down the biggest political stories shaping our world. Today, we're diving into President Donald Trump's Liberation Day tariffs, a sweeping set of import duties rolled out in April 2025, and the shockwaves they've sent rippling through the global economy. From slashed growth forecasts to market turmoil and retaliatory strikes from trade partners, this policy has become one of the most consequential economic moves of this administration. Let's unpack what happened, why it matters, and what could come next. On April 1st, 2025, nicknamed Liberation Day by the White House, President Trump signed an executive order imposing a 10% baseline tariff on virtually all imports entering the United States. But it didn't stop there. Certain regions and industries faced steeper duties. European Union, 20% on manufactured goods; Canada and Mexico, 12% on auto parts, lumber, and select agricultural products. China, already under a separate tariff regime, saw additional surcharges on consumer electronics. The administration framed these measures as necessary to protect American workers and reduce the trade deficit, continuing a protectionist agenda dating back to Trump's first term. But when you tinker with the rules of global trade, the effects can be far-reaching and often unpredictable. Within weeks, the International Monetary Fund revised its world growth forecast downward to just 2.8% for 2025, a steep drop from the 3.3% it had predicted at the start of the year. That's a collective loss of half a percentage point in output, equivalent to hundreds of billions of dollars in economic activity. Meanwhile, U.S. GDP projections fell from around 2.5% growth to just 1.8%, evidence that higher import costs and disrupted supply chains are already cooling domestic demand. The IMF warned that prolonged trade tensions risk a self-reinforcing slowdown. As higher prices dampen consumer spending, businesses pull back on investment, setting the stage for recessionary pressures. Financial markets didn't wait for year-end reports. In the week following the tariff announcement, the S&P 500 shed roughly $5 trillion in market capitalization. The Dow Jones Industrial Average dipped more than 8%. Yields on 10-year U.S. Treasury notes fell to multi-year lows as investors sought safe havens. And on Main Street, economists estimate these tariffs could add $1,200 to $1,500 to the annual household bill, thanks to pricier electronics, clothing, and even groceries. That stokes inflation, exactly the opposite of the Federal Reserve's goal to keep price increases in check. Higher headline inflation makes it harder for the Fed to cut rates, squeezing borrowers and businesses alike. Let's break down the immediate winners and losers. Winners: U.S. steel and aluminum producers enjoying higher domestic prices, select agricultural sectors benefiting from reduced foreign competition. Losers: U.S. automakers facing pricier parts and intermittent supply shortages. Technology companies reliant on global supply chains. Middle-income households bearing the brunt of higher retail prices. In other words, the policy risks rewarding a handful of industries while hiking costs for millions. As expected, key trading partners struck back. China boosted tariffs on U.S. agricultural exports, soybeans, pork, and fruit, pushing some duties up to 125%. European Union announced a 90-day pause on new tariffs while opening talks, but matched existing U.S. rates on whiskey, motorcycles, and jeans thereafter. Mexico and Canada leveraged NAFTA 2.0 dispute mechanisms to challenge the levies at the World Trade Organization, while imposing their own duties on U.S. steel products. Diplomats warn that a prolonged standoff could fracture long-standing alliances and drive companies to shift investment to non-U.S. markets. The risk? Spiraling tit-for-tat measures that undermine the very global stability essential for growth. We spoke with Dr. Emily Chen, a trade economist at the Brookings Institution, who cautions that once trust in the trading system erodes, it's extremely difficult and costly to rebuild. She notes that multinational firms may accelerate plans to relocate factories outside the US, eroding the administration's stated goal of bringing jobs back home. When you impose broad, across-the-board tariffs, you send a signal that no industry is safe from political risk. That uncertainty alone can deter capital investment for years. Looking ahead, three key questions remain. Duration. Will the administration maintain these tariffs through 2026 or scale them back in response to economic pain? Negotiations. Can Washington clinch side deals, perhaps promising reduced duties in exchange for manufacturing commitments? Global response. Will allies coalesce through the WTO or forge alternative trade blocs to bypass US markets? The answers will shape whether the Liberation Day levies are remembered as a bold move to rebalance trade or a political gambit that backfired on consumers, businesses, and international partnerships. That's our deep dive into the economic fallout of President Trump's Liberation Day tariffs. What do you think? Are these measures necessary to protect American interests, or do they risk hurting the very people they aim to help? Let us know in the comments below. And if you found this analysis useful, hit that like button, subscribe, and ring the bell so you never miss our latest political breakdowns. Thanks for watching, and we'll see you next time on Your Channel Name.